Hello and welcome back to Patrick Boyle on Finance, where we learn all about quantitative finance. Today's video is about stock index adds and deletes. So every year, different stock market indexes, things like the S&P 500, the Dow, the various Russell indexes, add and delete companies to those indexes. And this can cause very large moves in those stocks and provide trading opportunities for speculators. Stay tuned until the end of the video when I'll tell you the dates of the Russell Index rebalances, which are amongst the highest volume stock trading days of the year in the United States. Okay, so the workings of stock market indexes has suddenly become of interest due to coronavirus and the recent drama in the oil market. And in fact, I made a couple of videos about a week or two ago on that very topic. This could also become an issue soon for stocks because underperforming companies risk being removed from some of the larger stock market indexes. Indexes are guided by rules-based standards, but a committee gets to decide upon those rules. So while they're passive in that they just follow the index, the rules are actively decided upon. And these rules might have to change in the next little while. We'll soon find out. So the S&P committee decides how much time they give companies to bounce back if they no longer meet the standards of an index. Right now, there are more than 30 companies on the brink of removal from the S&P 500, which is quite significant. The S&P, as you probably noticed, has recovered significantly from its drop in March 2020. It was 30% lower back then than it is right now. And a lot of people are surprised at how well these stock market indexes are doing. Mostly this is due to the high weighting in technology and healthcare stocks. So certain stocks have done really well and other stocks not so well. Over the last 3 years, if you look at the almost 50 stocks that were thrown out of the S&P 500, they tend to be in industries like retail, industrial, and energy sectors. And so these turned out then to be the three sectors most affected by the coronavirus. Now, this wasn't by any design, it just happened to be the way it worked out. Stocks are removed from indexes for a variety of reasons. One is just mergers. If one company buys another company, well then it can't be that the bought company can no longer remain in the index. The other reason that they're thrown out of the index is just that they no longer meet the standards for index membership. So over the last 3 years, there have been almost 50 companies thrown out of the S&P 500. If we look at the returns of those stocks, we find that they are down around 47% year to date. So actually the removal of those stocks from the index has this time happened to help the index to perform a little bit better than it might normally be if it hadn't been adjusted. That means they are actually down more than 5 times the amount the index itself is down, which is kind of crazy. Certain stocks that were ousted were retailers like Macy's or Bed Bath and Beyond, and they're down 70% year to date. Now, most of the companies that were thrown out of the index were thrown out because they were already struggling, but then they also happened to be in the areas most hit by the lockdown. Index adds and deletes, as I mentioned, occur due to corporate actions and to no longer meeting the standards of the index in question. And some of those standards relate to market capitalization. The idea with the S&P 500 is, roughly speaking, it's the 500 largest American stocks. Human judgment, though, is part of the process, and the committee aims to minimize turnover, right? Because an awful lot of money is indexed to these stocks, and they don't want to just constantly add and delete stocks. So they try and keep it to a minimum, but once in a while, either due to a merger or due to a stock being no longer really representative and no longer meeting the standards of the index, it'll get removed and another one is brought in. And of course, this is of great interest to all kinds of traders. It's very interesting within the quantitative trading community because it's not necessarily that hard to work out which stocks are likely to be removed, and equally it's not that hard to work out which stocks are likely to be added to the index. Now, there are different criteria for addition and deletion from the indexes, and you can actually just look those up on the S&P Index Methodology Rulebook, which is available on their website. So a lot of traders do that, and they try to get ahead of these adds and deletes, because of course, if a stock is removed from an index, that means that all of the index fund managers have to get that stock out of their portfolio. And equally, if a new stock is added to the index, all of those big index funds have to add that stock to their portfolio. So quantitative traders will usually try to get in front of this, and they'll try and sell a stock short before it is pushed out of the index, and they'll try and buy a portfolio of stocks that are likely to be added to the index. And this is kind of a bit of an idea of what quantitative traders actually do. They try and just look for regularities in markets and try to trade ahead of these things. So in equity index, companies are removed when they fall below standards tied to things like market cap, profitability, and so on. And so market cap standards are reviewed from time to time based on market conditions. So as the market goes up and up, they'll increase the minimum requirement to be included in the big indexes. Right now, a company must have a market cap of at least 8.2 billion in order to be included or considered for inclusion in the S&P 500. Liquidity measures matter as well, because it can't be a company that's very thinly traded, because then it would be very difficult for all of these index funds to invest in that stock. In addition to that, the sum of the total earnings over the last 4 quarters must be positive, along with the company having to have been profitable in the most recent quarter. So those are some of the rules for inclusion in the S&P 500 index. So this February, in fact, February 2020, the standard of 8.2 billion minimum market cap was brought in. This was an increase in the market cap, and that was because markets were pretty much at their all-time highs at that point in time. Right now, around 20% or 1 in 5 of the stocks in the S&P 500 no longer meet that standard. So 1 in 5 stocks is actually eligible for exclusion from the S&P 500. So what does that mean? Well, what it means probably is that the committee will meet. They'll probably change that 8.2 billion minimum market cap standard, but equally they'll decide how much time to give these companies in order to recover. They don't just throw them out the minute they break the inclusion standards, because there's actually different standards for inclusion in the index and exclusion from the index. And essentially they will need to feel that these companies are maybe permanently impaired in order to remove them from the index. But this is what we'll find out, and this is what's interesting. Now, the committee probably don't want to add more tech to the index, because the tech weighting in the S&P 500 is around 26%, which is the highest it's been since 1999, the peak of the dot-com boom. So they probably don't want to throw out a bunch of sort of manufacturing or retail or whatever type of companies that are lagging right now and just load up with even more tech and move it to 46% technology weighting. That's probably not their goal. So it'll be really interesting to see what happens with the S&P 500 over the next few months. Now, the next big thing to talk about is the Russell Index rebalance. And the Russell Index rebalance is one of the most exciting stock trading days of the year for people. And the reason for that is that it's quite predictable. So the Russell indexes, like the Russell Value and the Russell Growth indexes, have trillions of dollars benchmarked to them, and they adjust their members once a year, and they announce in advance what the additions and deletions will be, and then that occurs a couple of months later. Turnover is likely to be much higher this year than usual, so this is something that is worth looking out for. Even in normal years, the rebalance of the Russell indexes is one of the highest volume stock trading days of the year in the United States, or for US stocks. Speculators and arbitrageurs trade ahead of these changes. You know, this is an old game on Wall Street. In fact, in my very first job, I worked on trying to predict index adds and deletes. And so because speculators and arbitrageurs are trying to trade ahead of this, a lot of the stock moves occur before the reconstitution date, which is June 26th this year. So there's firstly what they call the rank day, and the rank day is when the preliminary lists of index components is determined, and that's already occurred. That happened on May 8th, and then reconstitution occurs on June 26th. So it's worth paying attention to that in the coming month or so. Hopefully you found this video interesting and useful. If so, please hit the like button. If you'd like to see more videos like this, hit the subscribe button and the little bell button next to it in order to be notified of new videos. Have a great day and talk to you later. Bye.